Hi, everyone. Welcome to the show. Today we have Bikran Sandhu, the CFO and co-founder of Rise48 Equity. They're headquartered in Phoenix, Arizona. They buy apartment buildings and bring investors alongside them to give investors a return. So they have scaled their company to from zero to just under 2 billion in total transactions in just 4 years. And so excited to have Bikran on the show. And I've personally had experience raising capital for one of their deals as a limited partner. So excited to have Bikram on the show, and great to be with you.
Yeah, no, thanks, Wes. Really appreciate being on here, and thanks again for the invite. And yeah, let's get into it.
Yeah, for sure. So give us a brief background on yourself and how you started Rise 48.
Of course, yeah. So my background, I majored in college with an economics degree with an accounting minor, and moved into auditing right after I left college. So I started with Grant Thornton, which is one of the big auditing firms in California, and did that for about a year, and then moved to PwC, which is one of the big four auditing firms worldwide, and really kind of learned about how different companies run, the way they run their finances, and et cetera, for about 3.5 years. I spent total of about 4 years in auditing, and helped audit Fortune 100 companies, growth stage companies, pre-IPO companies. So really kind of like the breadth of the entire like financial spectrum there. Towards the end of my career at PwC, I started getting the itching for doing some management consulting. As an auditor, you kind of look at everything through like a back view mirror. You're kind of seeing everything that's already happened, and then verifying that that's been completed and it's accurate when it gets presented to the stakeholders. Well, I wanted to start kind of working with management on the front end so that once the results are completed, someone else can come in and audit it. So I wanted to kind of get into management consulting. Towards the end of my career at PwC, I found a local accounting consulting firm where I was able to kind of leverage my skill sets of what I did at PwC and GT, and kind of take it to that management consulting route. So spent about 4 years there, where I really cut my teeth with financial modeling, internal control processes, and learned about the different areas of operating a company and how to take it from point A to point B. So, I helped companies buy other companies, sell divisions, implement internal controls over newly acquired entities, to make sure that, when they do acquire something, that company just doesn't fall apart. It, continues to operate, help identify synergies for the different areas that the company operates in. And these were more smaller companies that I worked on. They weren't like Fortune 100. One actually was, but most of the companies were smaller companies that were trying to buy others or go public. So that really kind of helped me understand from a manager's perspective or the management's perspective how a company is run. Throughout my career in auditing and management consulting, I had a few real estate clients here and there, and really didn't really have a lot of background in real estate at the time. So I saw how these companies kind of run each other, and how like the managers get compensated, and, didn't think it was too complex. So in 2017, towards the tail end of, or actually just the beginning of my management consulting career, I started looking into real estate. And then in 2018, really kind of started educating myself. So I lived in California at the time, and in California, you can't really buy a lot of rental real estate. It's mostly fix and flips. You're buying a property for 300,000, putting in maybe 50, $60,000 worth of upgrades, and then selling it hopefully for a profit at $450,000. That's before any commissions or any fees that are charged on the sale. And really, I talked to a lot of local flippers essentially in California, and kind of learned that you really have to spend a lot of time. It's really active income. You have to spend essentially all your days overseeing the subcontractors, making sure the renovations were happening. And then if you really wanted to make money, you need to get your real estate license so you could be your own broker, so you can actually make the money on the fees and the commissions. Kind of quickly realized that if I wanted to build passive income, flipping was not going to be the way to go. I wasn't going to be able to, work on my W-2 job and kind of build this other income stream on the side. So started doing more research, looking into out-of-state investing, looking into out-of-state single family, multifamily, and started running some models, kind of determining, okay, well, my end goal is to achieve, say $20,000 a month in passive income. How do I get there? And every single time it was, okay, we're going to buy, 5 single families, 10, 15, 20, and then 5 years, 10 years down the road, we're going to get to multifamily. And every single road I took, it was going to end up in multifamily from my analytics side. So I figured, hey, why not just go into multifamily right away? At the time, I think this was like late 2018. We started looking at different groups of that offered, mentorships and really kind of get-togethers for different multifamily operators. And that's when I started realizing that my skill set was more on the Excel and analytics side. I don't have the relationship side, with the brokerage community. I don't have the investor relationships there to kind of buy and secure a deal. But my competitive advantage was I can underwrite a deal to the T and make sure that that underwriting was conservative enough and lucrative enough for everyone involved. But that's where I was looking for partners to work with, and that's how I found Zach Aptenstall and Robert Shevchik. They're our co-founders at Rise48. And in 2019, we bought a couple deals together, really kind of, dated to see how we kind of work together on the different deals, and quickly kind of realized that, hey, my competitive advantage was a perfect fit, for what Zach brought to the table and Robert brought to the table. And we kind of worked really well together. So in 2020, we co-founded Rise48 Equity. We bought, right at the end or the beginning of COVID, we bought our first deal together under this new brand. And, that was kind of hampered our business plan a little bit because we wanted to buy a lot of deals in 2020. But we, slowly bought a couple deals in 2020, and 2021 really kind of kicked it off. Bought 16 deals in 2021, 16 deals in 2022. And so far this year, we bought about 5 deals. And, we really want to scale and really make a business out of this and not just be like a side hobby or a hustle. So, we quit our day jobs. This is all we do every day. This is our bread and butter for our personal wealth as well as our company's wealth. And to date, we've bought over 42 transactions, or bought over 42 deals, sold 11 deals, and have about 31 deals under management right now.
That's awesome. Yeah, just to reiterate what Bikran said, they've scaled just in 4 years since 2019. They've scaled from zero, him and his partners, from zero to just under 2 billion in total transactions, which is crazy to think about. So great timing there with you guys. You put a lot of hard work in. So this is a personal question I had for you. What would you do if you were to start Rise48 over today?
Yeah, it's a good question. I think the main thing that I wouldn't really, change the way we hired our individuals or our employees at the company. Our first hire was our director of asset management, and then we hired our transactions associate, and kind of leveraged that from there. And I had read a book called The E-Myth, and that kind of talked about, how do you start a company? How do you make sure you can scale it appropriately? And one of the big tenets of it was, build out essentially an org chart of what your company would look like 5 years from now. Start putting in your name and your partner's names in every sector of that company or every single department. So that's what I did. And what we did was we slowly kind of identified what the key roles were, which we needed to kind of augment or supplement, so that Zach and I and Robert and I can kind of focus on the big ticket items like finding new deals and getting those deals under contract and continue to grow in the company. So from a hiring perspective, I wouldn't change anything. We hired Kaylee as our first hire. She was our director of asset management essentially, and ran the operations for the properties. And then we hired Brady as our second hire, who was helping Zach out with the transaction side of things. So taking those things off our plate really kind of helped us focus on the big ticket items like finding new deals, finding investors and kind of raising capital. And then the one thing I would say I would change is how we kind of approached our office space, really. When beginning of 2021, we had secured an office lease where we had around 4 to 5,000 square footage of total area, but we quickly realized we're scaling way too fast for this spot, so we had gotten under a contract to essentially lease out a space at another building, but they were taking their sweet time trying to make sure, or trying to get the tenant improvements done and stuff, and we were kind of bursting at the seams at the office that we were in. So instead of leasing at this other place and kind of doubling the size, we essentially went and bought our own building. So the thing I would do differently is not, kind of make sure that our hiring spree was appropriately taken into account based on the office space that we had. I wouldn't have signed another lease. I would have essentially bought a building, which we did, and make sure that we weren't kind of bursting at the seams at the old office space that we had.
When did you hire your first employee?
We hired our first employee in March of 2021, and then
So that's after you bought the deals in 2019 and 2020.
yeah, so in 2019 and 2020, Zach, Robert, and I, we would essentially get on Zoom calls at night to kind of walk through the asset management and look through the different deals that were that are on the market for sale. So what we would do is, like Zach and I had our day job. So I would work, he would work from 9 to 5, and then from 6 p.m. to like 10 p.m. or 11 p.m., we would just get on Zoom calls every single night, talk about how the deals are performing, and then talk about future deals that we wanted to kind of pursue. And during the day, when I was leading asset management, we had third-party property management at the time, so I was doing the weekly calls with our property manager to make sure that we were kind of hitting our business plan on our construction side and leasing side, and making sure that we weren't kind of falling behind on different items.
What are your roles at the company, and how have Zach and Robert complemented your skill sets?
Yeah, so my role at the company is primarily related to financial analytics. So on the front end, I'm leading the underwriting for all the deals that are coming into, essentially hitting our desk, and making sure that that underwriting fits the metrics that we have in place for reviewing a deal. And once the deal is under contract, Zach kind of takes over and leads the whole broker relationship and capital relationships to make sure we have the debt and the equity stacked up. Obviously, I'm reviewing the financials aspects of it, but he's kind of leading the relationship aspect. Once we have the deal, acquired, our asset management team would kind of take over and start running through our business plan. Our business plan primarily consists of doing exterior paint and refreshing the exterior of the building with new signage and design. And at that point, we'll also start taking care of the deferred maintenance at the property. So if it looks messed up or it looks like it needs a little bit of TLC, we'll go in, clean it up, take care of any like deferred maintenance on the site. And then at the same time, we would start going in and doing interior renovations. So we typically renovate units as they come up for renewals. So we'll issue a non-renewal, and then we'll renovate the unit and then lease it out to at a higher rate than it was previously under contract for. And we would kind of go through that business plan over the next 2 years. So our asset management team kind of oversees the actual execution. Robert, our co-founder, essentially makes sure that any renovations that we're doing and interior and exterior, they're up to code, and make sure that it's in line with our design language that we have for the property renovations. And then I, along with our FP&A team, or financial planning and analysis team, led by Matthew, he primarily, makes sure that from a lender and investor perspective, we're doing our reporting correctly, and we're reporting our results appropriately. I'm reviewing it, Zach's reviewing it, but I had initially kind of built it out on our end, and then kind of handed it off to Matthew and his team to do on his end. So they're running the analytics, I'm reviewing them, and we're all kind of making sure on an asset management perspective, we're hitting our business plan on a timely basis.
For sure. What does the underwriting process look like with your team? And then how is that different since you started the company?
Yeah, so at the very beginning, Zach and so Zach would kind of get the deals from the brokers. I would underwrite them, based on what I would see in the market for generic assumptions that you should be using. And then, based on the biggest, input on these underwritings is the rent comps. So what pro forma rent can you get based on the renovations that you do? If, the units today are leasing at, say, $900 a door, what rent can I get to after I renovate the unit? And that's where a lot of the work is involved. So Zach would essentially go out and shop the comparable assets of that deal. So, he'll go in the 1 mile, 2 mile, 5 mile radius, see which properties have a finish based on the finish that we have scoped out, and then see what rents are those properties charging. So if most of the properties are charging, say, $1,250, well, that's the number I'm going to put into my underwriting. So I'll plug in all the information into the model. And then after all the underwriting is done, Zach and I would kind of sit down together, see what we can offer on the purchase price, what type of terms we can offer, and he would kind of lead the charge on talking to the broker. Nowadays, we have an acquisitions analyst who's underwriting the deals, making sure that the basic information like the rent roll and the trailing 12 financial statements are incorporated into the underwriting. And then I would kind of take over, do the assumption side of things, make sure that, the higher level assumptions like debt assumptions or market rent or expense growth assumptions are appropriate. And then once I'm done with the underwriting, our asset management team would go out and shop comps, make sure that we can get the pro forma rents that we need to. I'll plug those into the underwriting, and then Zach and I would kind of sit down, talk about the deal, see what works, what doesn't work, what type of risk is involved at the deal level, and then how can we mitigate those risks, and what type of price we can offer to the seller. So it's gotten a little bit more. I guess you've had more hands in the pot, really, with an acquisitions analyst, the asset management team, kind of doing parts of the work, but it's kind of made it a little bit more streamlined as well, because now I don't have to spend, an hour out of my life to go in and underwrite the deal fully. I spend maybe 30 minutes per deal now, so that I can go ahead and do the higher level work as opposed to the basic work on the T12 and the rent rolls.
As a newer sponsor, and you guys having a fast growing team, how do you plan on moving through a potential recession?
Yeah, so I mean, we have been in a recession really for the past, I would say, since like June of last year, June 2022. And as interest rates have kind of creeped up, you've seen transactions volume really kind of dry out over the last 12 months. And I think I don't know if it was Costa or CBRE had sent out an article at the beginning of the year that Q1 transactions volume was down 70-80% versus prior year. So that was it's a significantly slower market. From an acquisitions perspective, we're still hitting the market as hard as we can. We're trying to find every single deal that's on market or off market, underwrite it, and provide feedback as fast as possible. From an asset management perspective, we're trying to be as conservative as possible for underwriting. So we're not assuming 4 or 5% rent growth in year one. We're zeroing it out. From an interest rate perspective, we're buying. We always buy loans. We always buy deals with loans with variable rate interest rates, and that's because we're doing value add deals. We're not doing operational deals where they just require a little bit of TLC and it's good to go. But with value add deals, you have variable rate loans that you have to leverage them with. So we buy caps that are deep in the money to make sure that our interest rate risk is not significant in the deal. So we're trying to make sure that when we buy deals, we're being conservative, and that for our rent growth and our expense growth is being conservative as well, as we project out these renovations for some of the deals, as well as what type of returns we can get for our investors.
What are the most important trends that you're seeing in the market today, and what investors should be aware of?
Yeah, I think the most important trends right now are making sure that the underwritings that you're looking at for new deals are conservative. I've definitely seen some deals where sponsors are assuming um, essentially growth rates or capex budgets that were pretty common in say 2021, and that's not common today. So buying deals based on historical assumptions and not what the current environment's at, it's really detrimental to everybody involved, because you're setting yourself up for failure essentially, because you're not going to be able to hit those metrics in the next 12 to 24 months. So what investors should be really cognizant of is vet the sponsor, make sure they have a good track record, make sure that they know what they're doing, that they're not just a someone who's doing like a side hustle or a side gig of buying a deal and they're going back to your day jobs and letting the property manager kind of run the deal itself. You want to vet the sponsor to make sure that they have skin in the game and making sure these deals are performing, and that they have a fiduciary responsibility to make sure that the investor is treated appropriately. So you could get into trouble relatively quickly if you're just working with a sponsor that is buying deals left and right across different state lines and doesn't really have a local presence. You want to invest with somebody who understands the markets that they're in, who has infrastructure in the markets that they're in, and who is essentially duplicating a strategy that they've done in the past, as opposed to trying to do some new things like converting hotels to multifamily or office to multifamily, or trying to just take a lot of risk just because they want to get a deal done.
Mm-hmm. So what are your thoughts on a fund versus a deal by deal syndication? Because I noticed you guys, you've launched 3 funds so far, I believe. Most of the investors come in on a deal by deal basis, a syndication. What are your thoughts on that?
Yeah, I mean, personally, I think, well, statistically, most of our investors, say 95% of our investors, like to invest deal by deal. They don't like to put money in the fund. They want to know the asset that it's going into. The funds that we have are typically blind pool funds. So in a blind pool fund, we essentially tell investors that, hey, this fund will be investing in Phoenix and Dallas markets over the next 12 months, and essentially any deals that we buy, this fund will invest anywhere between 2 to 5% of the total capital into that deal. And the first 2 funds that we did, they weren't marketed. That was all really Zach, Robert, and I putting our money in there and kind of starting to establish a track record. With Rise Fund 3, which was our first kind of marketed fund, that one was where we started taking in investor capital from outside investors. And for the most part, the feedback that we get is people want to invest in deals directly. They want to see the real estate that they're investing into. With the blind pool fund, I'm not allowed to, per the SEC regulations, tell you what type of returns you'll get, because I don't even know what returns I'll get you, because I haven't identified the deals. But once I've identified the deals and I can give you a deal level metric, that's when investors are interested in investing. So most of our investors still kind of invest in the deal side. They don't really like the fund side, just primarily because it's very sponsor heavy, so it's not easy to kind of dictate what type of deals we're going to give out to investors on that.
That's awesome. So I was told that your acquisition fee for when you buy each deal, I was told that covers the payroll of your company. So how do you balance quality versus quantity when you're buying deals?
Yeah, so ever since the beginning, when we launched the company, we knew it's going to be a transactions heavy company, because we want to build out the infrastructure for all the deals that we have. And the one place that a lot of sponsors can get into trouble is they're essentially involved in doing all the legwork for a deal. So they'll buy maybe 1 or 2 deals a year, but that's sustainable for them because they can then manage those assets from a very personal basis. We always knew we wanted to grow the company very large and wanted to make sure that we could be the #1 real estate company in the world one day, and we can't do that buying 1 or 2 deals a year. So from the get-go, we knew we were going to have a lot of transactional activity, and to support that activity, we needed to have a lot of payroll. So we essentially, at every single time we bought a deal, we would stash away a little bit of capital just for a rainy day fund at the company level, so that if we were to come across, say, a dry period of where we wouldn't be able to buy a deal a month or something, then we would have enough capital just to kind of keep the company afloat while the market kind of comes back, so we can go back and buy deals again. So, the transactional side, we always, made sure that we were able to, cover payroll and cover our fees for at least 12 to 18 months at the company level. If we just did not buy a deal for 12 to 18 months. And what we essentially did was stash away that safety, that rainy day fund, and then whenever we needed it, we could call on it internally before needing to essentially pursue a deal just to cover payroll. So that's how we've kind of approached that on covering the company operational costs for these deals.
Yeah, I know that you're involved with raising money from individual investors. Do you plan on raising from institutions in the future?
Yeah, it's it's one of our goals is to try to get into like the private equity side of things, to buy maybe the 1990s or 2000s product where it's not so much a significant value add, it's more of a, kind of hold for 10 years type of play. And the issue right now, especially in the market as of April 2023, is a lot of the private equity groups are kind of sitting on the sidelines. They're waiting for pricing to come down. We're waiting for their interest rates to come down so they can jump back into the market. We've been actively, working with a few private equity groups to try to identify deals that they are interested in pursuing. We know we have the infrastructure and the property management in place to be able to operate these assets. Right now, it's just a waiting game to see when these private equity groups would come back. But that is definitely, a secondary line of business we want to start pursuing, because we think, we have the capacity to do it. So why not, take a chance and move forward with that.
How did you go about raising money in the early stages of your company?
It was a lot of friends and family. So, in my career and in finance and in California, I'd met some people, here and there that were interested in investing. So the first deals that, that we did, I essentially reached out to the people that I knew, and even my friends and my family at home were the first people that I, reached out to and asked, hey, I'm doing this brand new thing. I want to, buy deals, and this is what we're going to do. So that was our first starting steps. And then as we started closing these deals and started refinancing, they started referring us more and more investors. So my friends, my family referred their friends over, and they started investing with us. So I don't raise a lot of money at Rise48. That's Zach's forte essentially. But my close friends and family are the ones that kind of invest with me alongside our deals.
What are your plans the next 5 to 10 years?
Yeah, no, we want to, again, we want to be the largest real estate company in the world. We want to own, the most multifamily in the nation at the very least. And the way we're going to do that is by scaling and growing. So our goal is to buy, depending on when the kind of market comes back, by at least 12 to 18 deals a year. And we want to hit at least $1 billion in transactions every single year. But that's gonna, it's gonna take a lot of hard work and a lot of infrastructure to make sure we do it right. So the goal is to build it out and then execute on the plan for the next 5 to 10 years.
That's awesome. Well, thank you for being on the show, Bikran. It looks like you guys have some incredible goals in the next few years. So I'm excited to, be able to work with you guys and possibly in the future. So
Yeah,
thank you so much.
of course. No, thanks, Wes. Really appreciate you having me on the show.